You're listening to the WBT Podcast with Micah Lodge. Listen to all of our podcasts at www.wbtpod.com. Stay informed. Let's get started.
And good morning. I'm broadcasting this from South Carolina this morning from my studios here. And I want you to know it's 28 degrees out this morning and there's frost on the lawn, and it's going to be a nice cool day where when you take a deep breath of air, you can feel it going into your lungs. So it's a great day. Hey, I was listening to a lot of different things over the weekend, but I read something from that was published in the Motley Crew, and the title of the article is Your 5-Step Recipe for Financial Success. And I wanted to go over it with you because I felt that the points that are being made in here are very good. The number one point that they're making was save at least 20% of your income. And I really agree with this because you need to save. A lot of Americans do not save because they are spending and spending and spending some more. It never ends. They keep on doing it. So Americans have this tendency that if they've got money in their hands, that it's time for them to spend it all away, but you can't do that. To be financially successful, you have a lot to save for, including retirement, emergencies, and unexpected expenses. To cover everything, aim to put aside around 20% of your income divided among retirement funds, which where at least 15% of your income should go, and other goals like funding an emergency fund, a saving for a house down payment, or saving for college for your kids, or even paying off your college expenses. In 2016, the median household income was $57,617, which means the median household should be saving around $11,523 annually. What would happen if you saved this much? If you saved $8,642 annually, 15% of your income in a 401k from age 30 to 65 and earned a 7% return, you'd have $1.19 million by retirement. And this assumes you never get a raise and don't get an employer match. If you saved $1,440 annually, 2.5% of your income in a tax-advantaged 529 account for 18 months and earned 7%, you'd have $48,958 for your child's college fund. And you'd still be able to save an additional $1,440 each year for other goals. If you save $2,880 per year, around 5% of income, or just over 10 years in a taxable account, earn 7%, and where in the 15% tax bracket, you'd have enough to put down a 20% payment on a $200,000 house. If you saved $240 monthly, around 5% of your income, you could save up a $1,000 emergency fund in just over 4 months, or a $2,000 emergency fund in just over 8 months. Let me tell you, excuse me, cold air this morning, getting into my lungs. Building up that emergency fund is vital. And it's vital because most Americans don't have an emergency fund. They don't have a cash sitting around in case a tire goes flat and they need to replace it, or the car needs tuned up, or you need to go to the doctor for an emergency visit. They just don't have an emergency fund set up. That's what you should really be focusing on, is saving and also putting together an emergency fund, because it's vital. Then setting a budget. I don't know any of my clients that come in and really set a budget. I mean, they kind of know what's in the cash and what they're going to spend it on, but they don't set up a budget to organize their spending. You know, these things you can accomplish by saving 20% of income. We just talked about that. You actually have to be able to save to achieve them. To do that, create a budget that prioritizes savings. 6 in 10 households have no budget. That is a sad number, which could be why 6 in 10 households don't have $500 in the bank in case they need it. If you don't have a budget, it's hard to know what you're spending too much on, or whether your money is going to the right places. With a budget, it's easier to spend less than you earn and prioritize savings. You can identify where spending is out of control. Decide how much to allocate towards different categories, like clothing, entertainment, and make sure outgoing expenses don't exceed incoming funds. And that's where I see it in my tax practice, is that I have clients coming in who are spending more than the amount that they're earning, which means that they're taking their credit card and using it as a loan justification at 18% interest, which is really stupid. So you need to create a budget, and you need to know how much you're spending every month. And let me tell you, don't do it alone. If you're married, sit down with your husband and wife, and you both work on the budget, because you're both responsible for that budget. Automate your retirement savings. Having a budget and living on a budget aren't the same thing. There'll be bad months when you overspend, and that's okay. What's not okay is short-changing retirement savings. Scary retirement statistics show Americans are woefully unprepared for retirement, and this can be a disaster since you cannot live on Social Security alone. If you automate your retirement savings by having a 401k or IRA contributions directly deposited each payday, the money will be taken out of your hands before you even see it, and you won't have the option to avoid investing in your future self. That is vital. You need to be putting that money away for retirement plans, because Social Security doesn't pay for much. It just doesn't pay. And then we talked about this just a few minutes ago, but having an emergency fund is vital. Remember that emergency fund you're saving for, turns out you really need it. Research conducted by the Pew Charitable Trust revealed 60% of households had experienced a financial shock like unemployment or a car repair in the past year. Around a third of families had at least 2 shocks, and the median household spent half their income on the shock. 6 months later, half of the families who'd had a shock were still struggling. They had $4,000 less in liquid savings and were more likely to be in credit card debt. If this doesn't sound fun, start by building an emergency fund of at least $1,000 and work toward a fund that will cover at least 3 to 6 months of living expenses. You can quickly build up an emergency fund by temporarily prioritizing emergency savings in your budget, cutting expenses, and taking on a side hustle if you have to. Once you have an emergency fund, use it only for true emergencies and rebuild ASAP if the money must be spent. I've seen this happen time and time again where my clients have these huge emergencies and they are in debt to credit cards. Build up an emergency fund. It is really important. The other issue is that you need to pay your bills on time. Around a fifth of credit card accounts were paid late in 2015, according to the Consumer Financial Protection Bureau. You don't even want to pay late. And you should set up automated payments or calendar reminders to avoid this calamity. Late payments come with penalties, up to $27 for a first-time late charge, or $38 for repeated late payments on the credit card. Fees on a mortgage are much higher. You're charged a percentage of the late payment, so a 5% late charge on a $1,500 mortgage payment could cost you $75. Late payments could also trigger a penalty APR, often as high as 30% on credit cards. This penalty APR may remain in effect once triggered, even if you become current on your payments. If you owe $2,000 on the credit card with 12% interest and make 3% minimum payments, you'd pay $861 in interest over the 9.2 years it would take to pay off the card. If a 30% penalty APR went into effect, you'd pay $8,088 in interest over a 29.2 year repayment period. So you see why a late payment is such a terrible idea? I mean, you don't want to be late, okay? So if you follow these rules on your personal financial side, in the end, you'll have a retirement plan, you will have an emergency fund, you will have paid your bills on time. It's a much better plan. Don't be like the majority of Americans who are living from paycheck to paycheck and don't have those funds set up to protect them in their time of need. And let me tell you, an emergency can happen at any given time. You have no control over emergencies. So start to think about your personal financial side for 2018. If you haven't done it yet, sit down and prepare a budget together for 2018. You have time. You've got a month and a half now. Not even that long. You've got a month and a week or 2 weeks, something like that. But you can do it. Just sit down. If you need help with it, just call us or write to us at our website, email address, which is mlodge@lodge-co.com. Or if you want to call us and set up an appointment and come in and talk to us, call us at our toll-free number, which is 888-681-1518. And we'll be more than happy to do it because, you know, you also need to start planning for your taxes. If you haven't sat down with your accountant by now and gone over your W-4 and what needs to be taken out for the remainder of the year just so that you don't overpay or underpay, now's the time to do it. It's vital to start preparing right now for your tax preparation for 2018. So you have two things to do. Sit down and prepare a budget. Three things to do that I really want you to focus on. Sit down and prepare a budget, build an emergency fund, and sit down with your tax practitioner and go over your tax needs for the remainder of 2017. So that when 2018 comes, you are ready to hit the tax preparer's office with good data. This is Mike Lodge for the WBT.
This is brought to you by Lodge & Co., a business and tax advisory firm where your success is our goal. Call us today toll-free at 888-681-1518 or visit us at www.lodge-co.com and learn more about what we can do for you. Lodge & Co., your source for sound business and tax services.
Thank you for listening to the WBT with Michael Lodge. Join us again tomorrow as we explore more about business and taxes. Follow us on iHeartRadio and go to our podcast website at www.wbtpod.com and listen to all of our podcasts and read our blogs.
World of Business and Taxes on